I needed to update this photo, and it's also winter, so apologies for the out-of-date photo there, especially coming to you from gray Seattle today. Hope everyone's surviving sort of the wild weather we've had around the country the past couple weeks. All right, so first off, who is Lighter Capital? We're, as I said, based in Seattle, and we're a team of serial entrepreneurs, technologists, and investors in the tech space. And we are a company that's using technology to provide capital to growing companies faster, more efficiently, and lower cost, and with more entrepreneur-aligned benefits than the traditional funding sources. We're not a bank and we're not a VC. And so we're using this innovative revenue-based finance model we'll talk about more today, which, as I mentioned, is more aligned to today's technology companies and the sort of subscription economy and the app economy that has grown into a very real thing and a very big thing over the last 5-10 years. And then, like I said, we use technology to make all of that very fast and easy and lightweight. We use several APIs to speed up everything so you're not faxing us tax documents and that kind of thing. So the goal today is to educate generally about RBF. Looking at the attendee list, there's a broad range of people from entrepreneurs and companies that might be interested in funding to finance professionals who are just more interested probably in the structure. So the first bit will be pretty general, and I'll try and talk about RBF generally. It can be applied to lots and lots of different things, so I'll try and be as general as possible, but we'll probably always kind of tie it back to technology companies. But then certainly the last bit of the webinar, I'll talk more specifically about our process and our model and how we use it. Okay, right, so like I said, general overview, the history, how does it work generally, who's it for? Again, the who's it for and where does it fit is going to be from the tech perspective. Like I said, you certainly can use it for lots of different things. You could finance your neighborhood newspaper boy or lawn care company or something if you'd like. We're using it for technology companies and particularly SaaS and subscription. We'll compare it to traditional sources as well, and then, like I said, dive into Lighter Capital's criteria and model. All right, so historically, royalty finance, it's been around for a long, long time, and it has traditionally been used to finance things that have really high upfront costs and kind of an unknown revenue stream afterwards, but where the revenue stream is basically costless, zero ongoing variable costs. And so those things have been movies, books, and then the commodities markets, oil wells, gold mines, that kind of thing, where, like I said, the variable cost going forward is relatively nil compared to the value of the product once it's complete. So how does it work? Simply it's a royalty. It's a % of the total revenue. So in this case, a company or the oil pumped from the well, a % of it goes towards the investor. In our case, it goes towards repaying the loan, our principal amount plus our interest. Okay, so let's compare it and let's talk about who it's for. I'm actually going to fast forward through all these so you can kind of get a look at everything as I talk through it. The yellow line is sort of your archetypal VC-backed business, right? Huge J-curve, deep spend, deficit spending, upfront, and even further. It could be, well into the IPO stage, still not making any money. We've seen. So that obviously needs huge upfront investment, and the revenue is, unknown down the road, and so it needs lots of capital, and that typically has historically been equity because that's all the company has to offer, right? And so our two examples here are a company that actually is successful, and the blue line is sort of the guesstimate of at the end of the day, and then the red line obviously is as we know, lots of explosions in the startup world and companies that are unsuccessful after raising equity and going for it, right? The prime example is Facebook, Twitter, Tumblr, all these companies that are building tremendous value but have no revenue model, right? Facebook's pulling it together and actually just reported pretty solid revenue, right, from its ad business for Q4. But up until recently, obviously if you have hundreds of millions of users and people are engaged daily on your site, that's a lot of value, particularly to investors, but there's no revenue there. So what do you have to sell, right? What do you have to offer? And it's a tech company with no real assets. So historically, equity has been the way to fund a company like that. The blue line on the right here is a company that doesn't have as deep of a deficit spend. Can either kind of, founders don't take salaries or invest money themselves or bootstrap and grow organically through revenue, sort of do the MVP at night while they're working, full time still. So they grow, and maybe they take on some bank financing or a line of credit or AR financing, but they end up selling relatively earlier, but owning 100%. And yeah, it's a little bit of a illusion here, or a trick of the eye, but the assumption is, hey, if you build and sell a $20 million business and you own all of it, at the end of the day, is that actually better than taking 3 rounds of VC and selling for $100 million and not owning 10% or less? And maybe that took you 7 years, whereas building a $20 million business took you 4 years. So there's this new. We've been seeing it, and this is partly why we started this company, Lighter Capital, is because this model on the right is becoming increasingly more common. Still, there are obviously big opportunities out there for VCs, and that's why they exist. And I mean, that's huge risk, huge return. It's awesome. There's just increasingly more and more businesses that are online because the internet and the software industry is just continuing to grow, and it has no sign of stopping. And so more and more, there's more B2B businesses. Really nice subscription businesses are growing, and they're really awesome businesses that you can grow and own 100%, and take on some bank financing or cheaper forms of non-dilutive financing, and sell it relatively soon. As they say, the first 10 million is the easiest to make, and so it's a very compelling story, and we like to help grow companies from $1 million to $10 million. This is where I'll kind of give a plug. This concept isn't new. There's an angel investor named Basil Peters out of Vancouver, Canada, and he wrote a pretty interesting book a couple years ago called Early Exits. I recommend it every time I kind of talk about this idea, this concept. He's a big proponent of building a company to $1 million. The first $1 million is the easiest. The second's a little harder, and so on and so on. So selling a company for 10 million or 20 million and owning all of it and starting all over again in 3 years is not a bad way to go, as opposed to making a 15-year career out of trying to build a $1 billion business and perhaps not even owning that much at the end of the day. So that's sort of the quick case study from our perspective. This is obviously tech focused. Like I said, revenue-based finance can be used for lots of other things, but this is how it compares in the tech world. Okay, so where does it fit? It's revenue-based finance. So the first thing is no pure startups, at least not for us. There are angels out there who are contemplating doing pre-revenue RBF deals. We've heard of seed funds and that kind of thing dabbling in it as well. It's a different structure completely. Our revenue-based model requires at least 15K in consistent monthly revenue. We can talk more about that in a minute, but the bottom line is revenue-based financing is for established companies with a product and customers. So as I mentioned, initially, you're going to have to spend probably before you start making your first dollar. So where does that funding come from? Usually self-funding. You're either dipping into savings, or maybe you can work at night, or friends and family is the most common. We see a lot of friends and family loans. They're usually very friendly. It's certainly, buyer beware. It can certainly, if things don't go well, be a strain on family relations, and so it's something to keep in mind for sure. But it's often, like I said, pretty cheap capital for how risky the business is at that stage. Credit cards, that kind of thing. I would say, everyone thinks angels and VCs are where to go when you're pre-revenue and maybe even pre-product, and that's really not the case. There's very few, even angel groups that will entertain a sort of pre-product idea, the napkin idea. The real crux of it is, the deals you hear about that are like that, I'll be honest, it's because they know the entrepreneur. The entrepreneur has had a successful exit. They built a successful business or 2 or 3. They're well known, and maybe they've been working on this idea for a while, and they're finally ready to go. It's kind of a quote-unquote inside deal or a club deal. It's a known entity. It's certainly not sort of the, try and get a meeting and pitch your idea, and they're going to invest $5 million with pre-revenue and pre-product even. So that's the honest truth about sort of the angel pre-revenue deal. Much more common and is you've got some customers, you've got some traction, and you're ready for XYZ product development, hiring a sales team, that kind of thing. So, you can kind of tell that the angels and VC bar graph on here starts a little bit over to the right compared to bootstrap and self-funding. Crowdfunding is an interesting one. That could be a whole webinar all of it on itself. It has some potential, certainly Kickstarter if you're a product, and if you're sort of in the music arts industry, there's other sites. True equity crowdfunding is still a little ways away, although there's been some recent advancements. I'm going to leave that one alone. It's an interesting thing. I think we're a long way from having it be like anywhere remotely competitive on the same scale as these others. Everyone thinks it's going to be huge, and it certainly could be. Retail trading, equity trading, certainly exploded with some of the retail brokerages when they kind of came out in the last 15, 20 years. But and it could equally do the same, but keep in mind that time frame, 15, 20 years. So I think we're a ways from being at the same scale of E-Trade today. Strategics and banks, I think, are pretty self-explanatory. I guess the banks thing I'll mention quickly is if you're looking for big dollars, I mean, banks will lend you 25 grand, right? If you personally guarantee it. That's the big joke is if you keep 25 grand locked up in a bank account, they'll lend you 25 grand. And how useful is that, right? And even actually bigger deals, they still want some sort of guarantee, and certainly collateral and all that. If you want big dollars, a big term loan, you've got to be really established. You've got to be profitable for 2 years. I mean, the criteria is really severe to get bank financing, and it's really not at the scale that most companies need that we've found to get to the scale to get bank financing. So it's really not an option until you build it into your capital structure much later on in the phase of the company's growth. Strategic investors can get involved at all kinds of stages, and that's actually a pretty interesting one, especially if you're on some sort of platform or you work closely with some company. We work closely with Salesforce.com and the App Exchange companies there, and they're active investors in early stage companies that they think could benefit the platform and the ecosystem, and so that's a really interesting one. Microsoft does the same thing. All these guys do it. So if you're on a certain platform or if you're in a certain ecosystem, it's certainly worth reaching out to corp dev at those companies or even the biz dev groups and talk to them about opportunities. The big ones obviously are revenue-based financing, and then operating is something people don't often think about. And with SaaS, especially, if you're doing, like, something to keep in mind is, SaaS is a really interesting business because of the recurring revenue, right? It's not the perpetual license model. It's recurring revenue. But that can mean a lot of different things. And we've seen lots of companies self-fund by basically doing annual subscriptions with prepayments. And, I mean, think about cost of capital, right? If you do a discount on your monthly rate for 15% to get an annual prepaid contract, that's your cost of capital. You basically locked in a cost of capital of 15%, which is pretty good. That's actually really effective. So we've actually seen some pretty awesome companies grow by getting prepayments in and getting all the cash in, and they can fund operations for the subscription for the year and keep feathering it in. Another webinar we'll probably do in the next month or so is with one of our other partners, Wara, and who will talk more about subscription billing and accounting and things, because there's some really interesting things there with GAAP, and GAAP doesn't handle recurring revenue very well, and often people are kind of confused on cash versus GAAP and accrual accounting, but it's from a cash perspective, the recurring revenue model is fantastic. Something to keep in mind. Obviously, traditional vendor terms, getting paid on your receivables, or like I said, from your customers quick, and having longer terms to your vendors is a great way to increase your working capital. And then revenue-based financing, like I said, it's our minimum is $15K a month, and we can work with companies doing $1 million a month in sales. So we span the spectrum. There are certainly providers out there that do much bigger investments, more like a VC. And like I said, there's a couple angels and things doing pre-revenue deals out there as well. So that's what we're here to talk about today. All right, so how does revenue-based finance compare? And this is from the investor perspective. This graph's a little funky to kind of get your head around it first. Let me explain how this works. The y-axis is the reward to the investor. And so if the business is successful, that's the upside. Obviously, if the business fails, that's the downside. So look at the green lines. Basically, equity is taking the most risk and gets the most return because of that risk, right? They're participating in all of the upside and all of the downside. They'll get zero return if the business fails. They'll get a very significant return if the business is successful. And so in a bank loan, they take relatively little risk. They have collateral. They're first in line if the business fails, maybe even a personal guarantee. But in exchange for that, they don't charge you as much money, right? Relatively cheap, and relative is the key term there. I think if there's anything I could impart on you, it's that bank financing is not 3%. Everyone thinks because their mortgage is 3% that that's what they should be getting a bank loan at, and that is not the case, right? The mortgage market is very different than commercial lending, and we're relatively expensive money, and people often kind of balk at our cost, which is not that ridiculous. It's actually very much in line with our risk that we're taking, and more on that in a second. But because everyone's tuned into their mortgage rate as their only example of oftentimes their only real-world example of interest rates, they think it's just ridiculous. And so, it's a 30-year amortizing loan, right? We're doing 4-year amortizing loans, so it's a little different deal, and it's it's high-risk capital with no collateral. That's my next point is revenue-based finance fits somewhere right in the between. We get paid back out of revenue as you grow, so we are getting paid back right away. Equity investors don't get paid back at all, obviously, so they have the most to lose. We're getting paid back a little bit as time goes on, but no personal guarantee and usually very little collateral. So we're taking quite a bit of risk. So from our perspective, our risk return is about right in between a bank and equity, and it's been even sort of dequity, right? It's a little bit of both. Now let's look at it from the entrepreneur's perspective. All right, so a bank loan, if the business succeeds, the entrepreneur makes out like a bandit because they've had a really cheap cost of capital. But if the business fails, they're going to seize everything. You're usually personally guaranteed. You're on the hook for everything. Bad news. Equity investor, if the business fails, great. I mean, usually there's a liquidation preference, so I think this chart is actually even not that accurate. So they're probably going to get whatever dollars are left, but assuming a $0 exit, right? Relatively good scenario for the entrepreneur, relatively low risk for the entrepreneur. But if the business is wildly successful, like I showed in those graphs initially, the equity investor is going to take a big chunk of it, right? Equity could be potentially infinitely expensive, right? If Hey everyone, sorry about that. The phone system I seem to be on today automatically hangs up after 20 minutes, I think. So apologies for that. Yeah, sorry about that. And I was on a really important point there too. Equity investment is potentially infinitely expensive. So to finish that thought, this is all very hypothetical, but if you sell for infinite dollars and they own 50% of the company, they get 50% of infinity, right? I mean, I'm joking a little bit, but equity is very, very expensive depending on how the company does. So the green lines, the entrepreneur takes relatively little risk, but is getting less of the upside. And now the blue line is an interesting thing, right? So on the investor side, it was pretty spread evenly, right? It was kind of right in the middle, risk reward. But because we use basically the bank loan structure, but with the participation on the equity, it's actually a little bit of best of both worlds. So you're getting a relatively low cost of capital, but we're taking, no personal guarantee. We are first in line, so if there is any sort of liquidation, we do get paid up to our principal amount, but that's it. We don't participate in the whole sale of the business. So, if we lend you $100,000, that's the most we could ever recoup in the event of a sale or liquidation. So it really is the best of both worlds. On the downside scenario, the least risk to you, and on the upside, it's certainly more expensive than a bank loan, but a 25% interest rate compared to a bank loan of 12% is compared to equity expense of 100% or something even more, is certainly more aligned. Okay, so moving on. All right, so that's kind of my overview on revenue-based finance, and now going to dive into more about Lighter Capital and what we do. So we fund early-stage growing software and technology companies. Like I mentioned, our minimum revenue amount is $15K, on up to anywhere from $1 million a month and more. So, like I said, it's kind of consistent at $15K. We're doing technology and technology services companies, so we are working with consulting companies, especially if they're working on a product and want to pull devs away from consulting projects to work on a product. So that's by nature high gross margin, but just to make it clear, we're taking up to 10% right off the top line every month to go towards the payment. So you've got to be able to have gross margins to support that, certainly. We don't require profitability, but we do like to see, we're not a VC. We're not looking to fund into a black hole runway. We want to see that our money gets you to break even in some sort of timeline, right? Something like 9 to 12 months. And even if that's kind of the case, if it's going to be that long and it's not sort of close to break even already, it's probably a little too risky for us. But we can certainly take a look. And then, obviously, if you're purposely deficit spending to grow, that's different than just way out of control burn and and no discipline. We like to see management, really committed to the business and willing to grow. We don't do any founder buyouts or anything like that. And we want to, the entrepreneur that has 4 things going on, lots of plates in the air, spinning is not a great fit for us. We like to see committed, focused management. We do invest in U.S. and Canada, so pretty much across North America, all states, and use of funds, like I said, to grow the business. No debt refinancings or founder buyouts or anything like that. We want to see the money go into usually sales and marketing. It can go into new product development as long as there's an existing product. So how does our structure work and what is it? So we provide anywhere from $50K up to $1 million. And the key caveat is, if you're doing $50K a month, we can't provide you with $5 million. That is the land of equity. If that's the sort of goal you have in mind, or if that's the target and the forecast that you need to get to where you need to be for the end of the year, that's equity. That's where you're raising a quantity of money that is large enough that the only thing you have to offer is the equity. In our case, if you're raising money that's 10% of your revenue run rate annually, then you have revenue to offer in exchange for capital now. Some people say that revenue-based finance sounds a lot like factoring, and it kind of is. Factoring is where you are financing your receivables, you're financing existing purchase orders. Revenue-based finance is where you're actually using your future sales to get capital today. So we're actually taking the bet on future sales, not previous sales. So we're more risky than factoring, and we also can provide you a lot more money than factoring because it does include growth and future forecast. But that's the key thing. So if you're doing $1 million a year, we can provide you up to $300K, and for a lot of companies that's a great fit. Why take out $1 million and start paying for it either by way of dilution or by way of interest if you can't necessarily deploy it all? And take $200K from us now. 6 months from now, when you've grown and you're ready for more, get $200K again. That is cheaper because you've grown. So that's a really common thing with our borrowers. I think everyone's kind of in the mindset from just the way the equity world has taught us over the last 15 years that you've got to raise $2 million now to go. That's not the case. You're on a path. You're growing 20% a year. Take $200K, hire 3 sales guys. Go to 30% or 40% growth, take out $500K, hire 10 more people, hire some devs, new product, whatever it is, right? That is sort of the new economy or financing these new subscription companies that we encourage and we love to finance, So that's something to keep in mind. We've done 4 financings with one company. He's just grown and come back and grown and come back. We've done 3 financings with 3 companies, and we've done 2 with over half our portfolio. So it's really common. We actually talk entrepreneurs down in the amount that they want to raise for that very reason, for the cost reason and kind of target use of funds and that kind of thing. But then 6 months later, we'll do even more than they were originally talking about. So there's no set interest rate. The payment varies, and there's no set maturity. The payments are based on a fixed % of monthly net cash receipts, and that's anywhere from 1 to 10%. The other reason we only do up to 30% of your annual run rate is because if you're doing $1 million a year and you want to borrow $1 million, I have to take 100% of your revenue to get paid back the principal in a year. That's kind of a false scenario, but it's just for example, right? Like if I want to get paid back the principal in 2 years, I have to take 50% of your revenue, and that doesn't include interest or anything like that. So we only lend up to a third because we want to keep that royalty rate as low as possible and let you plow money back into the business and grow. So we only lend up to a third, and that equates to less than usually 10% of your top line revenue that goes towards the payment, which is where we like to be. And then the loan is terminated when the cumulative payments reach some sort of agreed on cap up front. It's a cap or a multiple on the original investment, usually 1.5 to 3x. It kind of depends on risk and the stage of the business and that kind of thing. We also include, we do include a small success fee. It's usually like 1% of the sale price. It's meant to be very, very small and sort of something that doesn't even impact your return if you do sell the business, but hopefully is just a small, extra return to us that would pay for a default somewhere else in our portfolio. So it's meant to be very, very small. 1 or 2% is all. So here's an example loan. A company's doing $1 million. Like I said, they borrow $200K, and so they owe us 5% of their monthly revenue until we've received a cumulative payment of 2x, which is $400K, and then we get a 2% upside success fee if the company is sold. And that does, that plays, people often always ask about that because that does impact the cap table a little bit. That can be very, very friendly to follow-on investment from equity investors. We can do all kinds of things with that. Happy to talk more about that in detail. Our goal is to we're aligned with you into your growth, and so we're not going to do anything in this structure that's going to harm your growth prospects or your ability to sell the business. So if we need to talk about one of these structures or something like that, or having some, well, it's always a conversation down the road when the time is right. But the key thing to know is none of this stuff is meant to block any type of future investment. So if you people are always like, well, what if I do go raise my Series A? Well, we'll talk about it and we can figure out what to do with the success fee, convert it into common, convert it into preferred, whatever you want to do down the road. So it's meant to be very friendly and not block anything. I think that's it. We do structure our loans so that the target, it may look like 100% interest. That's not the case. We target our loans to be paid back in about 4 years. Our cost of capital target is 15 to 30%-ish. You can see if you pay us 100% quote-unquote interest over 4 years, simple math says 25% cost of capital. Certainly as you grow faster, you might pay that back a little bit faster. That's our upside. The cash cost is fixed. Our upside is, from sort of the time value of money standpoint. And obviously the risk we're taking is that the company fails or it takes you 6 years or 7 years to pay us back. I think that's it on that. Yeah, so let's talk about how it compares to, and again, this is all from the perspective of our structure. Other providers or angels might have totally different structures and things. So we have very limited control provisions. We don't do a personal guarantee, and we don't take a board seat. I think we're a board observer in one company, and that's because he asked for it. He wanted our help and advice on various things, so he wanted us to be privileged to board conversations if anything came up, but we don't require it. No ratios or anything like that. No strict covenants there. So on that point about the board, we don't require a board seat, but we are all former VCs and entrepreneurs, and we're living and breathing this industry all the time. We're not going to get in and provide the strong mentoring and introductions and everything that a VC would. That's a ton of their value add. Is they have a huge Rolodex and a whole bunch of experience. We have a little bit of that, and we have a lot of that. We work with a lot more companies than a typical VC, so our time is spread much more thinly, but we would love to help however we can when the time is right. We also have a whole network of partners that we work with. Like I mentioned, Salesforce, all the way down to a consulting company here called Altus Alliance that does sales and marketing consulting. And so if you want to talk to somebody about helping you build your sales and marketing practice, we'd love to introduce you to them, and that's a win-win for everybody. Like I mentioned, we do take a small success fee. Banks, oftentimes with early stage deals, and early stage, like I said, for banks is a company doing $10 million in revenue. That's early for them, just to keep in mind. So they will take warrants even in those deals. And then VC, obviously, this is where most of the return comes from. VC is also obviously the most flexible. That's one of their big benefits is total freedom of cash and no repayment until there's a liquidation. We're, like I said, sort of best of both worlds. We're somewhere in between. You do have to pay us back, but it's very flexible and it's tied to your cash. So it's only when you have the cash. We are very fast compared to traditional sources of funding. Banks and VCs take quite a while and do very robust diligence. We certainly cross our I's and dot our T's, as they say, but we have APIs built, like I said, to pull in sort of QuickBooks financial data and your sales pipeline, and we can analyze your customer contracts and things very quickly and efficiently. We've done a $500K deal in 2 weeks. And that's pretty much it at this point. So you can learn more at glidercapital.com. You can start the process. We have a really high-level, kind of enter your basic information and get in our pipeline at secure, HTTPS, secure.glidercapital.com, and that will trigger a phone call. So if you submit your info there, we'll get a sense for industry, geography. Are you U.S. and Canada based? Are you going to fit our high-level screen? And then from there, we get on the phone with everybody and learn more about the business, tell you a little bit more detail how this might work for you and what your scenario is. And then if you have any questions for me, you can certainly reach me at rbelcher@glidercapital.com. Anything else in our process? So yeah, so I'll walk through our process quickly. That high-level screen, then we get on a phone call for an initial introductory call, and that's sort of our coffee meeting, if you will. That's where we learn more about the business and tell you more about how we fit. And then from there, we'll send you the logins to provide your bank account, your QuickBooks, and your Salesforce or CRM data, and we'll take a quick look. We'll model up terms for you, or if we have any questions, if there's like a big amount of existing debt or something like that, we might come back to you first. But usually we can model up terms, provide the terms to you, usually over email or phone call first. Figure it out, make sure it works for everybody, and then we issue a formal term sheet, and then from a term sheet, we can close in a couple days with formal legal. That's the process. We are senior secured. We do file UCC filing, but that's it, no personal guarantee. I think that's it. Should we do questions?
Yeah,
have we gotten some questions?
We do. We have a few.
Okay.
Here's one. From the entrepreneur's perspective, could you talk about how raising RBF first might deter equity investors or not?
Yeah, so that's a great question, and I kind of hit it a little bit. Oftentimes, the success fee is the biggest pushback, but I think I answered that question, that we're flexible. If you're going to go raise a big chunk of money from an equity investor, that's great. Oftentimes, I'll be totally honest, everyone thinks that that's what's going to happen, and they take some money from us, they double in size, maybe they take a little bit more, and they never actually end up raising the equity. It may seem like that's the route you want to go, and maybe it is, but from experience, it really never happens because, A, we can provide as much capital as an equity investor at cheaper, a much cheaper cost, and when you're ready for the next 300K, it's 24 hours. It doesn't take 6 months to go talk to all the equity investors and round up $2 million, right? Like, we can do $2 million easily over the next 2 years with you and just feather it in as you grow. So, I mean, I'll totally answer the question. If you raise a whole bunch of money 3 months after we do a deal, that's a little bit of a tricky thing. We're happy to stay in the deal. If they want to buy us out, they're certainly going to have to buy us out. We're happy to stay in the deal. That's a little bit weird. If it's 3 years from now, there's probably not much left on the loan, and we can easily be bought out or stay in at the same time. The success fee, like I mentioned, can convert. We can talk about it, convert into common. We can do all kinds of stuff. We can be very friendly there. But the biggest answer is, I think everyone is geared because we read TechCrunch and we read VentureBeat that we're going to go raise a big equity round, and it's just not necessary with today's business model anymore. So we've kind of nicknamed this thing capital as a service because we do our initial deal, and it might take a month to do, but then get management back into building the business. And like I said, it's 24 hours to provide additional capital. And we've got one company that's gotten to a point where he actually got offered a term sheet and he turned it down. Didn't need the dilution, didn't need that much money, and he's basically doubling every year or more.
We have a couple of questions around the success fee.
Mm-hmm.
So I think mainly there's one that well, they're asking what is the penalty for prepayment, and I guess you can talk about the success fee in light of that. But also, is the price of the loan fixed up front and doesn't change regardless of how long you're using the money? And is the success fee during the term of the loan or forever? Is it converted payment?
Yeah, that's a good question. I should have mentioned that. The success fee is tied to the loan. Usually it exists and it continues for about a year or two after the loan is repaid. The thought there obviously is if you sell the business while the loan is outstanding or a year after, we think that our money helped you grow and sell for that price, right? But if it's 5 years from now and we're long out of the deal, congratulations, we don't have anything to do with it. So it usually expires anywhere from when the loan is terminated to 2 years after the loan is terminated. The point about early prepayment, so there is no prepayment. You owe the 2x or the 1.5x or whatever it may be at whatever time. If, I guess every opportunity that comes up is an opportunity to discuss the scenario, but the gist is no prepayment, but there is no prepayment penalty, but you do owe the 1.5x or the 2x. Anything else on the prepayment? I think that's it. I think that's it on that one.
Yeah. And just a question on the sort of is the maximum 30% based on 12 months or projected forward 12 months revenue?
That's a good question. It's based on basically kind of the trend of the last 3 months historic. We always look at historic. It's really more valuable to us than growth. I mean, we look at your sales pipeline, but your forecast beyond the sales pipeline is not as useful to us as a lender than, say, an equity investor. So we look at the last 3 months and get a sense for the average and the growth rate, maybe even over the last 6 months or so. So we will certainly look at what you've done. We ask for 24 months of historic financials. We'll take a look at that. If you started 6 months ago at 0 and you're doing 50K a month now, we'll keep that in mind. And obviously the 50K, if that's where you are and it's pretty consistent and you've got good customer contracts, we will. That's your run rate. That's your revenue level.
There's a couple of questions, sort of, I think, to do with the application of ongoing monitoring. So the first is how do you input into the pipeline? So I'm presuming that means the CRM. And then will you need access for accounting till the term of the loan? So
yeah, that's a good point. I'll answer that second one first. Yeah, it was part of our ongoing. So one of our covenants are ongoing read-only access to your bank account and ongoing read-only access to QuickBooks or your accounting. We don't need read-only. If you use QuickBooks, we use read-only. We're building out APIs for Xero and some of the other Intact, some of the other accounting packages out there. If you use something else, you just have to send us monthly financial statements. So you do, yeah. Each month you're required to reconcile up your cash flows for the month and send us financial statements. We do have access to all that stuff ongoing as long as the loan is outstanding. What was the first one?
How do you input the pipeline?
So there's two things there. I don't know if that means, how do you get into our pipeline, and that's simply submit an application. I mean, it's not an application. It's whatever it is, like 25 questions that just say kind of what do you do and what's your revenue and what are your expenses for the last year and that kind of thing. How do you input your pipeline? You can send us an export of your sales pipeline, or like I said, we've built an API and connected up and done some analysis with CRM, at least with Salesforce. So if you use Salesforce, we can connect in and send you a verification link and OAuth, and it's pretty easy.
Another one along those lines. What's your perspective on top-line revenue-based versus EBIT or CFC?
Yeah, so I think that's just a question of accrual versus cash accounting. And what's our perspective? So we look at top line. So it's called a revenue-based loan, but really we look at cash flow. So certainly free cash if the company is generating is great. Bottom line is that's great. Profitability, cash flow positive, awesome. Like I said, we don't require it. We can work with companies that are losing cash and losing money. But we look at cash. We like to see the flow of cash. Do you get all of your payments in September of every year, and that's it for the year, or is it spread out throughout the year? So I think that's the question. It's basically just accrual versus accounting, or versus cash accounting. Yeah, we base all of our modeling off of the cash, and then we collect on cash each month.
There's a question here about sort of, I guess, our portfolio companies. So maybe you can talk a little bit about sort of some of the companies that are in the portfolio. Or
Sure. Yeah, that's a good point. We're kind of updating our website. It's the portfolio page is growing quickly, so it's out of date, and we need to redo it a little bit. We've funded 41. We've done 42 or some odd financings with 27 companies. So like I said, we do multiple tranches with companies all the time as they grow. The 27 companies are almost all entirely software and technology. We've done financings with 5 Salesforce AppExchange companies that are on the AppExchange and sell either add-ons to CRM or some standalone, totally independent software product that's just built on the Force.com platform. We've funded a couple Microsoft BizSpark companies. We've funded, I'm trying to think of some others that might be of interest. Yeah, I don't know. I mean, if you want specific examples, certainly hit our website and you can see the companies. I don't know what you're looking for, but exactly with that. We have some testimonials. There's a great electronic medical records company here in Seattle that's one of our portfolio companies. They're specific to the psychiatric industry, and they're growing like crazy. I think that's kind of it. I mean, just to be clear, somebody asked me like a while ago, like, who's in your portfolio? Have I heard of any of them? Probably not. I mean, maybe you have, but probably not, because like I said, we don't go try and do deals with Color and Facebook and Twitter and Blue Bottle Coffee and that kind of thing. We fund companies that are growing, are really nice, have high degree of equity or of founder ownership, and are going to go from $1 million this year to $10 million in the next 3 years and possibly sell, or $50 million in revenue and sell. But we're not there. You're not going to find them probably in TechCrunch or anything like that, unless they've got some great product press release or something like that. But they're not, they're not in TechCrunch for raising an A round from Battery Ventures for $25 million on no product. So that's our portfolio is just really solid companies making money.
This one just came in. How does profit fit in if a company is only breaking even each month? How does that work in terms of, I guess, assessing them?
Yeah, not clear on that question. Again, I think it comes back to accounting maybe. What we often find that's pretty interesting is our companies are break even month to month. They're small enough. They can manage cash and expenses, and then they'll take financing from us, and they'll actually deficit spend for 3, 4, 5 months, and hire beyond their means at the moment, and grow into that new level, and they'll increase sales, and they'll grow into profitability, sort of stair step up, and then do another financing with us and do the same. Like I said, those companies that have taken 4 or 3 tranches have done that. They can maintain profitability and grow, but they can take financing from us and use that money, and come out growing faster and at a higher level. So I don't know if that answers the question about profitability, but like I said, we don't require you to be profitable or cash flow positive, and oftentimes that's not the case, or it can be managed that way.
How's a loan treated for tax purposes? Is this really debt or considered a sale of an asset, i.e. a portion of future revenue?
Yeah, so it totally depends on the investor who's doing the deal. From our perspective, it's debt, and there's interest payments, so it's an interest expense. Okay. Well, everyone, thanks a lot. You have my email, and you have our website. And if you have any questions, we'd love to hear from you. And thanks very much for joining. And we look forward to working with you. Thanks. Take care.